Hey everyone, in this video I'm going to bring you another AI stock, BigBear.ai holdings, and answer if the stock is a buy, hold, or a sell right now. I'm going to consider its revenue, its valuation, its growth prospects to answer whether or not I think this stock is a buy, hold, or sell right now. So let's get right into the details.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So Big Bear AI Holdings revenue has grown nicely in the trailing 12 months from around 120 million as of around late 2021 up to 154.96 million in the latest trailing 12-month reported segment. Now, I want you to take a look at the total addressable market for artificial intelligence. According to Statista, the total addressable market for artificial intelligence is expected to grow to $1.85 trillion by the year 2030. That would be up significantly from the $207.9 billion in 2023. Artificial intelligence is popularized by large language models like ChatGPT, but there are more applications like driverless car technology, recommender systems, and more. The companies that stand to benefit from the growth in this AI surge is companies like Amazon, Nvidia, Alphabet, Microsoft, and more. Investors getting in today could realize exponential returns from investments that capitalize on the growing effectiveness of artificial intelligence. So now that you see the capability, the opportunity, you can see that BigBear.ai is only at the very beginning. If it continues to grow, it's got a very long runway to capitalize on a massively growing market opportunity. The next thing I wanted to compare is the operating profit margin over a trailing 12 months. Big Bear AI was moving in the wrong direction. That is until mid 2022 when it made some enhancements and started increasing its operating profitability. It's now at negative 21.44%, still much better than the negative 80% it was in late 2022. That's when the cost of capital started to rise, and many of these unprofitable growth stocks started to make decisions to focus more on profitability and less on growth at all costs. So looking forward at BigBear.ai and its prospects over the next few years, you can see that its revenue growth was very modest in 2023, just 1.5%, but that's expected to get better in 2024 with 10.4% revenue growth and then another 10% revenue growth expected in 2025. This is by no means one of those AI stocks that's growing explosively like Nvidia or Supermicro. This is a slower growing AI stock that's trying to find its way, find its balance, and grow more profitably, not just growing and losing a lot of money on the bottom line, as you saw its improvement in its operating profit margin. So the next thing I wanted to look at is its cash flow from operations to sales. You can see it at negative 18.56%, and like its operating profit margin, it's also improving and moving in the right direction. So the decisions that BigBear.ai made in 2022, late 2022, are starting to pay benefits in 2023 and 2024 early on. Now, that is coming at the expense of top line growth, but that's okay if the company is growing more sustainably, more profitably. I don't mind if the growth pace slows as long as they're growing meaningfully, in that it's growing and improving profitability, it's growing and improving cash flow from operations. All right, I also want you to understand shareholder dilution, the average shares outstanding. The number of shares outstanding is an important financial metric. If a company issues more stock because it is running out of money or it wants to invest in a new growth project, it has the potential to decrease your earnings per share. Look up here, when I have a net income of 1,000 and shares outstanding of 100, my earnings per share is 10. You take the net income divided by shares outstanding and you get 10. But now let's say you increase your shares outstanding to 200 and you have the same net income of 1,000, now your earnings per share is just 5. The same is true in the opposite direction. If a company is losing money on the bottom line and it issues more shares, it spreads out the losses across more shares, thereby reducing the loss per share, which is a tricky way to reduce the loss per share. Look at this point here. A net loss of 1,000 with 100 shares outstanding creates a loss per share of 10. But if you take that same net loss of 1,000 and you spread it across more shares, 200 shares, you now have a net loss per share of just 5. So it's a tricky accounting trick to get your losses reduced on earnings per share. So you want to take a closer look to see where the improvement in the loss per share is coming from. Okay, so now that you've got an idea of why this is important, you can see that BigBear.ai is diluting shareholders significantly from about 105 million shares outstanding in late 2021. It now has 157.89 million shares outstanding, so roughly 50% shareholder dilution in the last 2 years for BigBear.ai. That's significant shareholder dilution. And finally, I wanted to look at its valuation. And since the company is losing money on the bottom line and it's negative in cash flow from operations, I chose to use the price to sales forward ratio. And according to this metric, BigBear.ai is trading at a forward price to sales of 2.041. Now, while this is on the cheaper end of where this stock has traded for, going back all the way to January of 2022, that doesn't mean that the stock is cheap. Now, these valuations around forward price to sales of 10 achieved in early 2022 were unrealistic and inflated valuations. A lot of stocks in 2021 and early 2022 were trading at inflated valuations when the cost of capital was still much lower. Now that the cost of capital has increased after the Federal Reserve has increased interest rates, valuations have come back down to reality, and a forward price to sales of 2.041 is still not a cheap valuation for a company like BigBear.ai that's only growing revenue about 10% and is still negative in terms of cash flow and operating income. Although the company is making nice progress on those fronts, there is still room for it to improve. So, to answer the question I posed at the beginning of the video, is BigBear.ai a buy, hold, or a sell? I would rate it as a hold in the middle. I don't think it's poor enough to sell. I also think that it's not strong enough to buy. I think the company needs to demonstrate further progress in operating profitability and cash flow from operations while maintaining that double-digit revenue growth. So all of that happening simultaneously. Double-digit revenue growth and improvement in profitability and cash flow from operations. If it could do that for another 4 to 8 quarters, that can start to improve its prospects in terms of investment capabilities. Right now, it's still early stages, and so I would hold, put it on the wait list, and watch and see this company improve and make progress. If you liked the video you just saw and you want to see more just like it, please subscribe to the channel. I can't keep this channel free without the support of viewers like you. And if you're already subscribed, thank you, and I appreciate your support.